Hey everyone, welcome to another episode of Mayhem in the Markets, coming to you Sunday, July 2nd, 2023, brought to you by MacroVisor, where we make macro actionable, and by TraderAid, where we help you find your trading edge. First chart we have here is the triple Q, registering a near 40% gain year to date, bringing it to its best year, the NASDAQ 100, that it's had in its near 4-decade existence. Truly an impressive spectacle. The last time we got this close was in 2019, but before that, it had been quite a while. So what is this showing us? Well, first, it's showing us that on a daily basis, just per relative strength, the NASDAQ's no longer overbought, right? So this is actually a little bit bullish. It's over its moving average that I have here on the chart. I'm using the EMA 10, and it looks like it could potentially continue running, particularly because July is actually a pretty constructive month seasonally speaking. July is the best month of the year for the NASDAQ, going back 20 years of price action from 2003 through 2022. Now, past is not prologue. Anything can happen, and this rally has gone quite far. But I do need to mention seasonality because it plays a role. There are actually passive funds that are being added in July. When we go back 20 years of data, not just looking at performance, but looking at fund data, that's another factor to take into consideration. If you want to know more about that, you should visit TraderAid. I've got a whole navigating the markets I just put out that's got what happened in the first half, what I'm looking for in the second half, a lot of detail about the underlying dynamics in the economy and the markets. And you can get 40% off TraderAid right now using the code July 40th, July 40th at checkout. You can find more in the description on this video as well. On screen, we have TLT versus QQQ. We can see this chart, the jaws, they do keep expanding. Nevertheless, I don't think the correlation has broken quite yet. Why? Because this chart looks a whole lot like several others, including the difference between aggregate central bank liquidity and market performance, particularly when we're looking at global central bank liquidity, global M2 versus the market versus inverted real yields on various maturities of treasuries, as well as what we're seeing in the market's performance and the earnings yield that it has dropping, while we see yields on the 5-year tips rising. And so we have a market that, from many different perspectives, with equity risk premium at the lowest level between 10 and 22 years, depending on where you're looking on the yield curve. If you're looking at the bills, it's the lowest level in over 2 decades. If you're looking at the notes, like the 10-year, it's the lowest level in about a decade. Nevertheless, no matter where we look, it's still giving us a sense that these valuations are a little bit irrational, particularly in mega cap tech and meme stocks and some of the so-called AI beneficiaries, where they're very irrational. And the reason that is going to matter is because there is competition. For the longest time, we got accustomed to the idea of very, very strong equity performance because there wasn't really an alternative asset to allocate into, right? People couldn't go into bonds and get a reasonable return unless they went way out on duration, and then they're taking more principal risk. And they're also, if they're going to have to sell that bond at any point. Otherwise, of course, they let it mature. If it's a U.S. government bond, there's no real risk there. But if you're on a 10, 20, 30-year bond, how much of your capital are you going to keep tied up there, and for how long? So the question of fixed income starts to come back, because now we're looking at the best yields in nominal terms that we've seen in really in many cases decades. And in real terms, they're becoming attractive again as well. Now, we go longer out in the yield curve, yields aren't quite as attractive. But you go to the bills, you go to some of the shorter dated notes, there is certainly opportunities there that, to me, look better than where stocks are right now. So if I was looking to allocate capital and I was trying to find a safer place to put it in a world of very high valuations, a very concentrated rally, I would be looking at treasury bills among those allocations. For more ideas about what longer term allocations make sense, be sure to check out Macrovisor. We also have a 40% sale going on until just after 4th of July there. Check the description for details, but I should just put out the first half overview in her breakfast or in her weekend edition. Okay, and the weekend edition is a great newsletter. It's something that Aisha started on her own Substack and brought over to Macrovisor recently. It's almost on its 100th iteration. And we're really excited to have it at Macrovisor because it really helps to tie everything together. So we're going to be putting out more information about our second half guidance coming up very soon. And it's going to be talking about what we think is going to be opportunities in the market where there's outsized return potential, where there's downside potential that could be cash raising opportunities or short selling opportunities. And talking about that, not just looking at the United States, not just looking at stocks, but looking globally and looking at other asset classes as well, including currencies, commodities, bonds, and markets around the world. So something to pay attention to if you're interested in longer term swing trading and investing. That's one of the things that we're focused on in Macrovisor with that macro focus. And while it has seemed like for some time macro didn't matter, it still does, and it will continue to. And one of the things that's powered the market for so long has been the temporary pause of treasury issuance combined with so much central bank liquidity coming into the market. And that may not necessarily be something to hang one's hat on for the second half of this year, given that we have such a large amount of treasury issuance that is soaking up some liquidity in bank reserves. Morgan Stanley estimates about $500 billion worth. Some will obviously come out of RRP as well. But the other component of it is that we are still in an earnings recession. There is some downside risk. Most of the earnings models are looking for earnings to continue to slow, negative growth of up to negative 16% coming into the last earnings season of this year. And that would tell us what? That we have some more downside potential, that risk hasn't been realized. Now, I realize this sounds strange with the market having rallied as much as it has, but if you go underneath the surface, you will notice something pretty intriguing, that it's about 15 stocks carrying the market higher, and the other 485 in the S&P are only up about 1% year to date. That's not the raging, roaring bull market that we keep hearing about. It's a very narrow, constrained environment that needs to broaden. And if it does, the bulls have it and it can keep running. But if it does not broaden, and if we continue to see this sort of stretched rally built on the back of an AI narrative that has yet to prove itself, and a handful of companies that are continuing to get more irrationally valued. Look at Apple. When you take out share buybacks, earnings are negative year over year without any adjustment at all. Revenues negative year over year. And the company just added $1 trillion of market capitalization on a year that should be considered by any reasonable stretch a loser, where growth is not happening. Now, granted, Warren Buffett is a lot smarter than I am. He's bought a lot of this company recently. He's made a lot of money on it, and congratulations to him. It's a great play. But we are also at a point where valuations are getting way ahead of themselves versus the kind of growth that isn't even happening, but is still being priced in. And that's one of the things this chart helps to illustrate as well. Another thing that we can see that we've talked about is equity risk premium is at very unattractive levels. By this measure, it's at levels we haven't seen since, I want to say, about 2000, 2001. Certainly been multiple decades. And why is this important? Because the earnings yield on the S&P 500 is not attractive. It makes much more sense to get exposure to fixed income because you have an opportunity to get the full faith and credit of the United States government paying you more than 5% on maturities that, you can hold for a matter of weeks or months. And if there's a better opportunity at that point, by all means. But for me, I'm just not in the mood to go in and start buying one of the most historically expensive stock market environments that we've seen in a long time, where if this new bull market did start, it was from the highest valuations we've ever seen. The first bull market to happen during an environment of inverted yield curve, the first bull market to happen during such an aggressive Fed hiking cycle before a recession is rare. It can happen. But the earnings recession is also not over. And I know the market likes to look forward, but the worst is yet to be behind us. And even if we have the earnings trough happening in the fourth quarter of this year, it's unlikely that October of last year was looking forward to, 14 months forward and saying, okay, we know where the trough in earnings is. This is where the market's going to continue to move higher. I think instead, and we've seen this sometimes throughout history, we are in a very long cycle that is ending. And there's so much liquidity that's been added into the system with near constant emergency level monetary stimulus and some degrees of fiscal stimulus over the last 14 years that, yes, there's going to be some sloshing around of that exorbitant amount of money that's been added to the system. Further, credit conditions haven't tightened quite as much as one might have thought. There's been offsetting components of the Federal Reserve's tightening policy, such as the cessation of Treasury issuance from January through June, the Bank of Japan and People's Bank of China's stimulus measures, and the Fed full well knowing all this and not really increasing QT as they probably should have when they slowed down rate hikes. So that's also helped to lead to some of these liquidity effects. But I think it's important to look at this from the context of, we're at a point where the market is, many parts of it at least, are priced to perfection. I would say energy is objectively cheap here. Doesn't mean I want to go really long energy, but it does look like there are at least some mean reversion opportunities in energy. But in terms of mega cap tech and the communication sector and the so-called consumer discretionary sector, which has a huge weighting to things like Amazon and Tesla, so it's really more just tech in the top weights, these are areas where I think the market's a bit stretched. And so that's, if I was going to be allocating long, I would not be going very long into the first half big winners after July. I think July, this month, is the last month it has to really run. Seasonality is a part of it. Flows are a part of it. But I think also reality does begin to set in during this earnings season. I would be very surprised as comps are getting more difficult that this is going to be a really strong earnings season. The other thing I would be concerned about with everything that's just happened is that estimates are actually going up, which means that not only are comps more difficult, but we're also going into an environment where analysts are more bullish, so the bar is higher. This is not just about beating a very low conservative estimate. It's actually going to be about beating a higher estimate, and year over year comps are going to be more difficult. So the bar is going to be higher for these companies to, I think, perform in any way that reconciles what the market has priced in. And this is another chart. This is one that I was talking about earlier. It's hard to put a chart like this exactly into words, so I think seeing it is a lot better. You can see the earnings yield in the NASDAQ 100 falling while the 5-year TIPS yield is rising. This is divergence, and this chart goes back 5 years. So this is not just a short-term correlation like some of the 2-year correlations we've seen between bonds and stocks, and particularly long-duration debt and equity. This is a chart of earnings yield and 5-year TIPS yield. The divergence suggests to me that the NASDAQ is wildly expensive here. And we can see it across the board, just like the average PE of these mega caps being in excess of 30. That's wildly expensive, particularly for companies that are not really growing, with the exception of Microsoft, where their growth is marginal. Caution is warranted. I know that it's an environment where a lot of people are very excited because they're starting to make back some of the losses they had from, the late part of 2021 and on. I would just say, if you're in a position where you've taken a huge haircut and you're very excited that you're going to make it all back, please be careful. Rallies like this do not happen often. When they do, and they're on such thin breadth, they often do not end well. And I know that there are some folks out there that are just going to say, oh, he's just a bear, he's a perma bear, blah, blah. I was very bullish throughout most of 2021. I started to get cautious in the fall, and I got straight up bearish in January of 2022. And the factors that have made me bearish are still largely intact. And I think that's important to think about because, look, first of all, I believe that there's a lot of misunderstanding about how one might express their views and how one might position for those views. If you look underneath the surface of the S&P 500, those 485 stocks that average 1% up year to date, there's plenty of downside alpha. There's been plenty of opportunities to catch large cap shorts. But when you go to mid cap and small cap, there has been a lot of bloodshed out there. There has been plenty of opportunities for bears and bulls to succeed this year. It's a rare environment where, depending on how you're trading this market, you can make money shorting commodities. You can make money shorting certain parts of the yield curve. Some of the bonds have fallen further this year from their peaks. You can make money shorting a lot of these small cap stocks. There's been lots of money making opportunities in these regional banks. Obviously they've recovered, but they're probably not out of the woods yet. So when positioning normalizes again, there could be some fades there. There's been lots of opportunities, no matter what your convictions are. And the best opportunities in my mind have actually been pair trades, right? So rather than saying I'm long and that's it, or I'm short and that's it, pairing one asset long versus another short has actually been one of the best ways to trade this year. And one of my favorite pair trades this year has been long Japan, short China. I'm out of it now because it worked really well in short order. I'm still constructive on Japan. I'm still bearish on China. So it's a trade I'm likely to put back on. But I'm just waiting a little bit for a more ideal entry point to do that. But for a trade that might work in the near term, it might be a good opportunity to look at longing low vol large caps and fading high beta large caps. That's one that I'm considering putting on because I think we're in an opportunity where the high beta stuff has run so hard that this trade might be ready again. It's one that I've talked about on TraderAid. It's one that I've identified several key points where we've had opportunities to trade it up and down. And it's been a very interesting trade because essentially you're just playing rotation. Now we're going to look at the balance sheet of the big five central banks versus the global stock market. This is another chart I was referring to earlier in that QQQ versus TLT chart, and it's a very similar chart. Actually, the divergence is similarly large and started around the same time. What does this tell us? It tells us that global liquidity doesn't necessarily support where the market is, and that could be something to keep an eye on because we are seeing more signs that that liquidity is likely to fall further as the year goes on. And we have a very interesting view of the yield of S&P earnings in purple, corporate investment grade debt, AAA rated, in green. And in the darker, I want to say that's more of like a black or a blue, the 3-month treasury yield. And what you can see is that corporate yields and 3-month treasury yields are well above S&P earnings yields, which are continuing to fall. What does that tell you? By this measure, the risk premium is inverted. There's no reason to own stocks here whatsoever. One should be very careful in this environment because at the end of the day, it makes a lot more sense to have fixed income. I mean, you're basically taking needless risk in equities here, buying in this type of an environment. There have been better opportunities to buy the equity market where you're getting paid a much better risk premium. This is not one of them, and that's one of those potential entry signals when you know that equities are presenting a compelling offer versus what you can get in fixed income. And this is an environment, by the way, most people are not used to because we haven't seen an environment like this. As you can see on the chart, the purple line hasn't dipped below the 3-month treasury in a long time. I mean, I think if I'm not mistaken, we're looking at about 20 years, a bit longer perhaps. That's meaningful. And that tells you that this is an environment where most managers, most investors, most traders are not prepared for what this could mean. But what it often does mean is that stocks are going to get cheaper because there's better opportunities elsewhere. Stocks are priced to perfection in an environment where they're not performing. I mean, the stocks are performing for some companies, but their earnings are not. Now, NVIDIA may be a rare exception. Let's see what happens this earnings season where they project $11 billion in sales. I still do believe that AI is in a bubble, but I do believe also, as I've said the whole time, that there's incredible potential with this technology. It's going to take some time to come to fruition. We're not quite there yet, and the defining proof will be the show me component. When we see productivity and margin gains in earnings, AI can be a reality rather than a show me story. Right now, with the amount of returns that have been pulled forward, it is still a show me story. And a sustained crush in equity volatility today also risks violating the long-term lagged relationship between the interest rate cycle and the VIX, which suggests that the impact of higher rates has yet to be felt and that the average VIX level should not peak until 2025 at the earliest. So there's a couple of ways that one could look at this relationship. The way that I've chosen to look at it is it suggests that there's a pull higher potentially in the VIX that could happen here in the year ahead because of this 2-year lag, right? So if most of the rate hikes happened in 2022, then as we get out to 2024, we could see vol meaningfully rise as a result of this lag if this relationship is still intact. And the alternatives to equities is another view on the same thing we looked at earlier, have become significantly more attractive. Again, I really favor the 3-month yield and the 6-month yield on these bills. These are both really attractive to me. A 3-month deposit rate is probably going to be referring to CDs, but still 3-month bills, 6-month bills, very attractive to me here. Investment grade corporate debt's also pretty attractive. The AAA stuff from companies are not going anywhere no matter what. But I'm not a fan of the US 10-year Treasury. Don't want to touch it. Don't think it's attractive. Think that the yield could go higher, but even if it doesn't, I have no desire to have that length of duration with the U.S. government, just none at all at this point. I think that there is more turbulence ahead with government debt, but it's not going to be in a default. It's not going to be anything of that nature, but it could still put upward pressure on yields in the next 10 years. And that means I want to be very short on duration. I want to be 3-6-month yield. Maybe I'll talk about a 1-year note. Maybe I'll talk about a 2-year note, but that's about it. I'm not going to go further out. And hedge funds, last checked by Goldman Sachs Prime Desk, had 258% gross leverage on, which is the highest level in 5 years. And what that really means is they're very long, they're very short. They're more long than they're short, right? If you look at net leverage, they've been long for many months. I know some people are saying, oh, hedge funds are getting long now. No, hedge funds have been long. They've been increasing their longs. And they're very short, but they're more long than they're short. And what that does is it adds systemic tail risk, right? Because you could have a situation where the market goes meaningfully against them. And in this case, it would be like the NASDAQ going down and the Russell going up. In essence, that would hurt a lot of the ways these guys are positioned. And we've had days like that. And I've speculated publicly on Twitter that some of that is probably driven by hedge funds flattening these really, really leveraged books. Now, what does that end up meaning? It means if we have a day that's more violent with the NASDAQ down and the Russell up, it can feed on itself and you can have some disorderly deleveraging, right? And that's something that's typically not going to be very good for the overall market. It can add to volatility. It can add to forced positioning changes by other parties who are getting stopped out. So I would just say this is one of those risks that's not necessarily talked about enough. And I know that we went from this mantra of, oh, the hedge funds are very short the market to, oh, they're getting long. The reality is they've been long the whole time. The short interest that was bantered about was just in S&P futures, and that was looking at it two-dimensionally without considering the rest of their book. So I would say when you look at the entire book of hedge funds, the reason they're aggressively shorting the S&P earlier this year was to hedge out their long books, which were larger. Now they're expressing that short interest in other areas. So we're seeing S&P futures open interest fall a bit. We're seeing positioning square. So it's squaring up to being more flat to long. But what does that tell us? It means they're distributing their short interest elsewhere. So what are we seeing? Well, single stocks now have about $1 trillion of short exposure. So we can see that larger players are moving their hedges and their shorts to other places. The other thing we're seeing is skew is back on the rise. Put skew is pretty meaningfully elevated here. So S&P, VIX calls are also very popular. So, S&P puts, VIX calls, Russell shorts, single stock shorts, they're employing these same hedges in other places. But rest assured, you can know that hedge funds are very long this market, and they have been for some time. This is not a situation where hedge funds are just starting to go long now. And anyone that's suggesting that is the case is either looking at a very small subset of hedge funds that missed the boat, or they're not looking at the data properly. And here's another look at hedge funds. One area they actually are short is regional banks. And this exposure is the lowest that we've seen since 2019. It is meaningful. It's one reason I don't want to go heavy-handed short the regional banks here, even though they have problems. There's already too much stretched positioning in this part of the market. And we can see global CTA exposure to the S&P 500 per Goldman Sachs is very long. If we do have a reasonably strong sell down, they have about $70 billion worth of exposure to get rid of. If it's a mild sell down, it's closer to about, call it $12 billion of selling to do. Either way, there's just not as much longing from these momentum chasers. That doesn't mean there's not other parties in the market that can get long. CTAs are part of a very complex market, but this player is pretty maxed out and would have a lot of selling to do if the momentum shifts the other way. And China stocks lost their 200-day moving average. This was a really interesting development. Now, at MacroVisor, we've been pretty openly bearish of China at TraderAid. I put on the long Japan short China trade. We've been talking about China being skeptical of the reopening for some time now. And actually, it was really cool. My partner Aisha got to go on Bloomberg, Daybreak Middle East, and talk about what we're doing at MacroVisor, including that China short. And not long thereafter, when we talked about it, it broke below its 200-day, and it's really going back into a very questionable state where year-to-date gains are being given back readily here. So we're at an environment where China stocks are looking very vulnerable to further downside. The technicals look disastrous here. And I think the macro situation there is, for a number of different reasons, not so great. If you're interested in why, check out the MacroVisor podcast. It's free. You can find it on any major podcasting source, Apple, Amazon, Google, Spotify. Just type in MacroVisor. You'll find our latest podcast about China and the UK, and you might find it an interesting listen. And if you do, give us a review. Let us know what you think. And China's holiday tourism moderated in June, much slower than what people would have expected. And we're seeing these charts at the percentage of the 2019 level. So basically it's trying to say, okay, are we normalizing? And really, by most accounts, in terms of revenue and average spending per tourist, we're still seeing subdued activity. There's no revenge spend trend in China like there was in the United States post-lockdowns. And high net worth individuals moved a lot of assets into cash this year, and it's likely that they're still remaining in that allocation as money market inflows remain at their best levels for the first half of the year ever, on track for their best year ever. And that's suggesting there's a lot of folks that are in cash. That's the default if you're at a broker and you're not allocated, is to have your funds in the money market. And it's an attractive yield. What can I say? You get 5%. Why wouldn't you do it? Disposable income, outlays, and savings. What we're seeing here is that personal savings are rising. Disposable personal income is growing a bit, modestly, but outlays from the prior period, month over month, are slowing. That is to say, spending is slowing. The economy is slowing. It's good for inflation. It's bad for everything else. UK CPI, speaking of inflation, we can see headline is dropping as energy prices do. There's a really big correlation between CPI and energy prices. When you look at them, you'll see that the year-over-year change tends to be a pretty strong positive correlation chart, and there is causation. Energy has a big role in stimulating inflation. On the other hand, core CPI is accelerating in jolly old England, which is not likely to make their central bank very jolly at all. They just hike 50 bips. They may hike more, even up and over 6%, as they try to get inflation under control. UK is experiencing the worst inflation in the so-called developed world. And Europe's growth is projected to fall further. Just moving a little bit further to the east, we can see the Euro area's industrial production is expected to fall further. When we look at Euro area M1 push forward 6 months, it suggests that we have some falling to do in terms of industrial production activity. Why does that matter? Because that strongly suggests a recession. You can see the last times that industrial production activity have fallen, as is projected to happen here, we've seen a recession happen. So is this time different? It's likely not the case. We're seeing signs from various European economies, France, Germany. Obviously, UK is not part of the European Union, but we see signs of weakness there. There is some divergence from the southern neighbors like Greece and Italy that are doing a bit better. But overall, I'd say the euro area is, first of all, their equity markets are wildly mispriced. But secondly, the economic risks are actually growing. And I think that's a theme that in the second half of this year, we may see more evidence of that potential slowing and then contraction in the economy of the euro area. Weak export growth is also a factor over in Asia, and it's actually stimulating a foreign exchange war. Because how do you get customers to want to buy your stuff? You make it cheaper. How do you do that without cutting the prices for all the companies and their profits? Well, you cheapen your currency. So the companies still keep the same nominal profits, but the products appear to be more competitive. In a world of rip-roaring inflation, it's always interesting to want to depreciate one's currency, but Japan and China and Taiwan can afford to do it to some extent because their inflation hasn't been as problematic. In fact, Japan is celebrating inflation. The return of inflation after decades has allowed their economy and their financial markets to gain some ground. Banks are spending more on interest than they have in years. The industry spent $72 billion on interest expenses in the first quarter, more than their average quarterly profits. This is kind of a big deal, and this is without banks even normalizing the rates they pay on savings accounts, on CDs. So if they did, the interest expense would obviously go quite a bit higher. And their net income isn't necessarily going to rise a lot unless they're issuing a lot of loans at these higher rates, which some banks are starting to do, curiously. There is more lending than one would have thought, but it's not all rosy everywhere. We just got the Dallas Fed survey on what's going on in their regional banking, and it's not looking so good. We see contraction in credit issuance, tightening standards. We see commercial real estate showing increasing signs of stress. And so we can have a sort of narrative here that commercial real estate is probably going to be what leads regional banking into trouble. I've been posting a lot about that on MacroVisor, on Twitter. I've been talking about it on YouTube. It's an important theme. Even if you're not interested in the macro or the economy, which if you're not, I don't know why you'd be listening to this video, but if you're not, it's still something to keep track of as a risk. And bank reserves are set to decline by $500 billion with the passage of the debt ceilings from Morgan Stanley, and it is looking at the TGA being refunded and bank reserves dropping. It's modeling out RRP as well. So it's a pretty cool chart here. I overall agree with what it's saying, and the overall overarching theme is that this refill of the TGA and this issuance of debt is going to be pulling funds from both the reserves of banks and the reverse repo market, which I largely agree with. Now, the liquidity effects of that are probably not going to be great, but they will take time to be realized. I know there's a reflexive propensity to discount anything that doesn't materialize in the next 5 minutes as being false or FUD or, bear porn or whatever. But the reality is that this kind of stuff, it's risks to identify and watch in case they come to fruition, rather than just assume it means go full portfolio short S&P or go full portfolio long near dated S&P puts. And then if you're wrong, you're just done and, you never trade again. The reality is that there's a lot of nuance to positioning, to trading, and most people who know how to play this game, they can be bearish of the overall market and still be making money in pair trades, in relative strength trades, in trades outside of the stock market, which, believe it or not, there's a lot of stuff to trade outside of stocks. So, and again, this year, there's been so many opportunities for both bulls and bears in the stock market to make money. If everyone's winning, or if at least a lot of people are making money, there's no reason to complain. There's certainly no reason for a lot of the sort of attacks that people engage in on social media, which I find to be a really sad state of affairs, that people don't have better things to do with their time. I would think if they're doing really, really well in the market, they would probably be spending more time on vacation, going to various exotic parts of the world, celebrating all of their gains than attacking internet strangers. But hey, they can do them. I will do me. This is the federal budget surplus and deficit. And we can see that it's the highest levels in a long time. I want to say it's the highest levels, in nominal terms since the late 90s. But nevertheless, it's a really concerning level because it does imply that there's going to be an ever increasing amount of unsustainable spend, particularly as interest costs are rising. And interest costs are expected to rise over $1 trillion in the year ahead, which means that there's going to be an even higher deficit, and that deficit is going to be on paying down interest on debt, where we're not even touching the principal. The U.S. government is like the largest interest-only buyer there's probably ever been on planet Earth. And young borrowers are taking on more debt. This is kind of sad to see. You've got the 24 to 34, the 35 to 44 seeing their debt rise. But what's worse is the 20s to 30s are actually seeing another phenomenon which really concerns me, and that is that their delinquency rates are the highest that they've been since 2010, which was just after the great financial crisis. There was a lot of stress back then. There was a lot of joblessness back then. It took years for the economy to recover, and these folks are in trouble. And that does concern me quite a bit. You also see the under 24s, how much their debt exposure is accelerating. So there's just a lot of folks that are not having a good time in this economy. And unfortunately, some of it has to do with age. Unfortunately, millennials and particularly Gen Zs have been kind of priced out of housing, priced out of the economy, priced out of the American dream in a lot of cases. Not all, but many. 40% of Gen Z lives with family because they've been effectively priced out. And speaking of priced out, share of student debt outstanding by age, it is going to be a big deal when this stuff has to start being paid back, because these are the same folks that are not doing as well. The 18 to 39 group in particular is a demographic we've been watching, and those consumers, a lot of them are living paycheck to paycheck, about 67%, and about 40% are struggling to pay their bills on time. So this is, again, another area where there is concern that as we go further into this year, this, especially with a push like having to repay your debt, or at least being told you should, could cause some additional stress. And Fed funds futures are now modeling a cut as early as March after Friday's PCE data. We had seen the futures push this out as late as May, but that was taken back after Friday's cooler than expected PCE data. And some people ask, why do you watch Fed funds futures? It seems like they don't matter. They change all the time. It's a way of gauging sentiment in the market. It's that simple. Inversions, recessions, and interest rates, we can see that short rates are higher than long rates, and that often precedes recession. You can say that the Fed funds to 10-year Treasury yield curve is inverted. So I want to thank you for watching. This has been a really fun episode of Mayhem in the Markets to make. There was a lot of slides, a lot to go over. I got to talk about some of the work we're doing over at MacroVisor and TraderAid. I want to encourage you to check out that work. If you enjoy what I'm doing in these videos and you're more of a long-term trader and investor and you have more of a macro focus, you'll like MacroVisor, and you can get 40% off your first year, whether you choose a monthly or yearly plan, with the promo link in the description below. Also, check out TraderAid.com, where you can learn more about technical short to intermediate term trading. We also have a macro overlay, but it's more short term. You get 40% off using the code July 40th. That's July 40th at checkout. Follow me at Twitter at Mayhem for Markets, as long as Twitter still exists. That username, you can find me on a number of other venues using that username as well, where I'm just starting to get going. TikTok, Instagram, we'll see if I can get out there on some others. I'm also just Mayhem, at Mayhem on Substack. And be sure to like, subscribe, and share this video around with your friends on social media, on whatever platform you prefer. I'm trying to get out to as large an audience as I can. I'd like to help as many people as I can. I'd like to network with as many other like-minded people and people of opposing views, as long as they're capable of a civilized debate. But as always, really appreciate you all tuning in. This has been Mayhem in the Markets, and I will catch you next week. Have a great holiday ahead.